Hello, everyone. Thank you so much for joining us in our presentation today. We are Team 3, and throughout the course of the summer, we have been researching the fintech and wealth tech space, specifically the technological investment processes that have made the investment process a lot easier throughout the years. And thus, we titled our paper The Road to Easy, and we will bring you along in our journey today, discovering different technological innovations and how they have shifted the investment platform. So, when it came to researching and doing a deep analysis of our fintech companies in fintech space, we came to the understanding of an algorithm. And this algorithm was through successful attributes that we noted as a team. And there are six successful attributes that we outlined throughout the summer, and we wanted to acknowledge them to begin. So, first and foremost, we came up with the idea of innovation. All successful fintech companies have the concept of innovation being able to create a new and unique product offering that enhances an existing problem or a solution. And similarly, it can also be redefining to create a different alternative approach to an existing problem or solution. And similarly, with this sense of innovation, there needs to be agility and adaptability. So companies need to create new products that they are pushing to the market to enhance the innovation and also developing innovative approaches and adapting to it. And then with the onset of technology, it comes with some technological advancements. So companies need to remain customer centric. And this is by using easy to use products with accessibility and an educational component. So all investors in the space can understand it alike. And then also with these competitive products, there needs to be a sense of competitive advantage as well. By leveraging the market and outperforming competitors, companies are able to push their products out further and succeed. And also, this can be done through a cost-effective pricing structure as well, which we will note throughout the presentation. And then finally, with the success of their products and their processes, there needs to be adoption and reputation. So the biggest part of adoption is marketing and leveraging these strong partnerships, in which we will outline throughout the presentation as well. And similarly, clients are more likely to work with companies that they trust and value their status and familiarity. So many of these companies have to develop strong reputations to enhance their products. So, as we approached our paper, we came across the concept of democratization. In the fintech space, democratization is the concept of inviting more and more investors into the space despite their backgrounds. So, this is a space in which amateur investors and investors who do not understand the market necessarily as well as more sophisticated investors are invited to invest and be a part of this space as well. And technologies such as commission-free trading and robo-advisory are just two of these mechanisms in which democratization has taken over in the fintech space. So prior to democratization, how investing used to look was a broker would have to be involved and people would have to call to buy and sell their shares of stock through their broker. Now, with commission-free trading, people are welcome to trade online and eliminate that middleman, which is the broker, and they do not have to pay these large fees to their broker, which allows them to make a greater yield on their investments. In addition, a new concept known as robo-advisory has emerged over the past few years, and it is with strict algorithms and robots that take clients' interests and preferences to invest automatically. So even if someone doesn't have the background in investing, they're able to use robo-advisory to automatically invest for them. And with these advanced technologies, some successful attributes that our team came across that made them successful was innovation, adaptability, customer centricity, and adoption. And some companies that we will see today that are advancing with these platforms are Robinhood, Fidelity, Charles Schwab, and Betterment and Wealthfront. And democratization is a concept in fintech, which I outlined. However, it is not limited to just commission-free trading and robo-advisory. What you'll notice is it comes across many different technological and investment spaces. So Matt is going to outline how he sees it throughout indexing as well.
Thank you, Kay. So, indexing is the main method of passive investment in financial markets. It gives great diversification and stable returns. Definitely one of the best roads to easy. Initially, indexing was something done through index funds. These are mutual funds that would simply buy a sample of stocks or bonds to get broad exposure to a certain market rather than actively managing a portfolio. Vanguard is a prime example of a successful company closely tied to index funds. In terms of its success factors, Vanguard is a first mover. They innovated by launching the first public index fund and achieved significant adoption due to their lower fees. This was risky, as Vanguard focused exclusively on indexing, but it paid off. Index funds were a huge success, and as a first mover, Vanguard gained the advantage of being the most knowledgeable and the reputation as specialists on index funds. Their strategy of expanding offerings and continuously pushing to reduce fees made Vanguard dominant in the index fund market. However, it is important to note that Vanguard's current customer service issues could harm their carefully crafted reputation if not addressed. As technology has advanced, indexing has also evolved. Two major examples are exchange traded funds, ETFs, and separately managed accounts, SMAs. ETFs function like individual stocks on an exchange, but still passively track the market like an index fund. They offer lower fees, intraday trading, and higher liquidity. SMAs, on the other hand, act like a personal fund where each position is managed separately. This allows for direct indexing, a use for SMAs that focuses on tax loss harvesting. Uh, Basically, by owning individual stocks instead of single vehicles like an ETF or fund, investors can claim investment losses to offset taxes from capital gains while still passively investing. BlackRock is a company that excels in these modern indexing methods. Unlike Vanguard, which was a first mover and heavily invested in index funds, BlackRock is a fast follower that initially specialized in risk management when investing. It's a very adaptable company, and to gain a large market share in ETFs and SMAs, BlackRock instead chose to acquire two firms, Barclays Global Investors, which includes iShares, and Aperio. Instead of creating completely new divisions within BlackRock, they chose instead to acquire and enhance the offerings of these already existing specialist firms in their desired market. BlackRock's personal competitive advantages lie in its adaptability, low fees, and customer-centric investment ecosystem. They offer a large catalog of products, use their scale to keep fees low, and combine these strengths with the specialization of acquired companies to provide high-quality services. Now I'll hand it over to Alex, who will delve deeper into personalized investing through model portfolios and portfolio design.
Thank you, Matt, and also thank you everybody for bearing with us throughout this presentation. So here we actually have portfolio design, and really it should be called next generation portfolio design. So here we have three companies that we like to really highlight as being next generation, and talking about them in terms of our successful attributes. So we have Endeavor, BlackRock, and MSCI Fabric. So getting into Endeavor is an individual investment solution in that um, they offer clients the ability to be able to input their information, such as, let's say, your tax bracket, your the amount of contributions you expect to make, the amount of withdrawals you expect to make, and based on that they will build you 3 to 5 custom portfolios that are completely unique to you and to you only. And they're great because they truly allow investors, for a fraction of the cost of what a traditional advisor might charge, depending on the area that you live in, to be able to get access to these services and be able to invest knowing that your future, whatever your goal may be, whether it be, to leave a legacy or to build a foundation for, your children's education or something like that, you can do that with Endeavor. However, they do struggle in terms of agility, as they really, they don't have a great team of advisors in terms of that. They're not a very big company. Moving on to BlackRock, they offer probably the most advanced risk analysis tool of all time so far, being the Aladdin AI system. Aladdin basically runs through thousands upon thousands of financial statements every year, and really tries to get an accurate picture of, what is going on in a specific market sector, what is going on in a specific company, what is going on, in an overall economy, and works in that risk analysis sense. And BlackRock really offers great economies of scale with their funds, which is why they've been so successful. And lastly, we'll move on to MSCI Fabric, which, according to our research, is a great wealth manager focused solution. And they offer state of the art tools that nobody else offers, not even the Aladdin AI system, being API integration, ESG tools, and perhaps the best one would be alternatives modeling. And more is yet to be seen. Fabric was acquired by MSCI recently, which is a renowned data provider in the financial world. So we've got more to see. And now, probably for my favorite part of this entire presentation, alternatives, where we'll be covering Yield Street and NASDAQ private markets. So Yield Street offers individual investors the ability to invest in private assets. And you do need to be an accredited investor for most of these investments, which is an investor which has considerable more amounts of wealth than an average person might. And you can really invest in all sorts of different things. You can invest in a bridge financing, in a private loan, and some private equity offers. Let's say through KKR, which is a large private equity firm. They do struggle on the reputation side in terms of the fact that they've had some liquidity problems with their current provider, which keeps all their funds, and they also have had reputational issues because they have been sued by the SEC for misleading their investors. Lastly, we have NASDAQ Private Markets, which is also a brilliant company in that they offer you the ability to be able to purchase shares in private companies. So these are household names like Discord, ByteDance, and SpaceX, and ByteDance being the private or the bigger company that owns TikTok. And with the Nasdaq brand name, their great reputation, and their partnerships through firms like Morgan Stanley and Goldman Sachs, they basically allow these partner firms to be able to offer their employees and investors liquidity and be able to invest in alternative investments. Besides offering, all sorts of different tools for banks and for institutions and wealth managers to analyze private investments. So now I'll leave it to Eric to cover second part of alternatives, angel list, and seed invest.
All right, thank you, Alex. So continuing with our discussion on private markets, we're now going to shift our focus to two more companies, AngelList and Seed Invest, both of which allow investors to invest in startup companies. So AngelList acts as a matchmaker between startup founders and accredited investors. Traditionally, angel investors were ultra-high net worth individuals, which made startup equity highly exclusive. However, AngelList has significantly lowered the bar and allows any accredited retail investor to partake in this market. Contrasting AngelList, Seed Invest operates similarly to a crowdfunding site like GoFundMe and allows startups to spread their funding across a number of smaller investors rather than relying on a single large angel investor. Both AngelList and Seed Invest boast customer-centric designs. AngelList's platform is notably simple and intuitive, which makes it easy for users to search through investment opportunities. However, AngelList's main advantage over its competitors is its cost efficiency and the exclusivity of its market. While traditional methods of investing in private equity charge large fees, Angel Invest allows investments with no upfront cost. They charge interest only on profits made by investors, which incentivizes customers to use their platform. Additionally, partnerships with private market service providers improve the platform's efficiency and its reputation. Contrasting this, Seed Invest's biggest competitive advantage is its accessibility and its low barriers to entry. Unlike other platforms, including AngelList, which require users to be accredited investors, Seed Invest has no restrictions on who can use their platform. Their minimum investment of $500 is substantially lower than the traditional requirements, which makes it an appealing option for gaining exposure to the startup equity market. So moving on to accessibility. Growing demand for alternative assets has put pressure on wealth managers and financial advisors to offer their clients access to these products. This has created a significant opportunity for the next two companies we're going to cover, iCapital and Case, which are currently the two largest platforms providing access to alternatives for wealth managers. While their individual offerings differ, both have achieved great success by leveraging cutting-edge technologies, creating user-friendly interfaces, and offering transparency and education to their users. So in addition to the cost efficiency of their platforms, strategic partnerships have been crucial to both firms' success. In 2013, Case formed a strategic alliance with Fidelity, which integrated their platform into Fidelity's wealth management branch. This partnership greatly expanded Case's reach to a number of Fidelity's customers and solidified its reputation in the financial ecosystem. Similarly, iCapital has received backing from some of the largest asset management groups, such as Credit Suisse, and it formed a key partnership with BlackRock in 2016. These partnerships have helped iCapital integrate into the financial ecosystem and improve its reputation. The adaptability and agility of iCapital and Case's platforms are also among their main strengths. Both firms continue to integrate cutting-edge technologies through in-house innovations and a number of acquisitions. For example, in 2024, iCapital launched a distributed ledger technology fund, or a DLT fund, which is noted to improve data processing efficiency and reduce errors. I'm now going to turn it over to Sunny to discuss tokenization and our concluding thoughts.
Thanks, Eric. As Eric mentioned, more fintech to wealthtech firms are making the private market more accessible to their clients. We think that tokenization is the next transformation that will change the wealth tech industry. So, what is tokenization? Tokenization means converting rights to an asset into digital tokens. Using blockchain technology. Digital tokens are created to represent a fraction of ownership in an asset. These tokens can be traded on digital platforms, meaning more people can invest in high value assets without needing to buy the whole thing. Tokenization offers many benefits. It improves liquidity, democratizes access to different assets, classes, and increases transparency and security through blockchain. Companies like Polymath and AlphaPoint are leading this revolution. While these companies might not be household names, they have some key success attributes driving this transformation. For instance, Polymath uses this innovative polymesh technology to tokenize real estate, allowing clients to buy a fraction of the house or property and have a user-friendly platforms clients can access. And AlphaPoint provides liquidity solutions and educational resources to help investors to adapt and navigate the tokenized asset market. Of course, there are challenges to tokenization, like regulatory compliance, cybersecurity concerns, and the need to market acceptance and an understanding as when other fintech or wealth tech innovation occurred. But tokenization is positioned to change the financial landscape by making investment more accessible, and liquid, adding transparency, security, and customization to the mix. As we conclude our paper, we wanted to find out if successful fintech companies have a set of successful attributes that wealth tech companies are also following. Our research identified 6 key success attributes. We explored these by looking at both well-known asset management companies like BlackRock and more niche ones like Endeavor and MACI Fabric. Our paper reviewed all aspects of investment management, from the creation of online brokerage platforms to the development of the new instruments like ETFs, and from the rise of robo-advisors to the advanced technologies and structures of companies. As we look to the future, tokenization seems to be the next frontier in wealth tech, promising to further democratize investment by breaking down valuable assets into accessible digital tokens. We hope you enjoyed this journey through the fintech ecosystem into wealth tech and our exploration of the factors we believe are critical to success. Now we will have time for questions, but before we would like to acknowledge our amazing mentors, Rob, Katie, and Dylan for their mentorship and supporting us. We wouldn't have done it without them. We would also like to thank the program for allowing us to have this great experience this summer. Thank you.
Mr. Thomas,
You.
Great. Thanks. Yeah, great job, guys. That was a really interesting presentation. You covered a lot of topics. One thing that I was thinking about early on the democratization of investing is that I wonder if there's any downsides to that for younger investors who maybe they don't know a lot about investing and they know more about trading than investing. And for example, I see some of my students buy GameStop every now and then, or the DJT was a SPAC. Now I think it's a stock. And I just wonder if you think there needs to be some kind of education that goes along with the democratizing of trading or investing for younger investors. I guess maybe some of the other presentations today might address that as well, though.
Mr. Thomas, thank you for your question. And I just want to also acknowledge that that was a point we did come across when doing our research. And the educational component, I think, supersedes any aspect of investing. And so when it comes to new technological innovations, one example I can think of is AI. You cannot completely eliminate the human component of it. You want the AI to support human development and human actions. So I think the same in the investment space alike. If it comes to technological innovations taking over the investment space, there is still a need for us humans to step in and do the research that's necessary. A lot of the times you're filling out a questionnaire which asks about risk tolerance or what type of investments that you need. And prior to that process, you do need to have some awareness of the market and some knowledge of investing. You cannot necessarily go into anything blindly, and I would not recommend that. So I think that is a caution that you have to take moving forward in the future of technology in the fintech space. But also, I think that you can use it as a supplement to the education and the knowledge that you gain on your own outside of the technological platforms.
Great. Thank you.
Thank you.
Mr. Janako?
Yeah, I'm not sure if you explored this, but well, first and foremost, thank you for your presentation. It was awesome. But I'm intrigued with some of the facts that came out of the women the women project against this one, right? So Joe observed in a chat that women might leave their financial advisor through sort of trust issues, so the human component on the women presentation, especially in the context of the great wealth transfer where women are going to sort of rise up and own more of the assets. It's interesting how this phenomenon, the technology phenomenon, sort of is maybe a little against that trend. Did you guys look at in your project sort of the male-female lens relative to some of these futuristic platforms that may make their way in?
I can take this. So, well, we did not specifically research the impact of women and men into the investment space. We did target how different backgrounds entering the investment space can be benefited through these processes. And I think to speak to your point, in which you do not need a financial advisor necessarily to invest now, given that democratization has taken over in different various steps. So I think it is one step forward for women in this space in which they are able to learn more through education, as well as be involved in the investment space now that it is so opportunity rich. And again, while we did not research specifically women and men specifically in this finance industry, we did research how more and more groups of people can be invited into this space.
I think we might have a paper for next year, Joe, kind of how these 2 points come together.
Yes, no, there's several papers that have come into my head today, so that's terrific.
Nice job, Team 3. That was great. Thank you.
Just a really difficult a lot of difficult topics and complicated areas, and but really handled very, very well. And you're going to have a lot to talk about in your networking calls and interviews. A lot to talk about. And thank you, Rob, Katie, and Dylan. Terrific, really terrific work. So really great content. Okay, Melissa, I think we're ready for Eileen.
I'm sorry, because this question is right down our research. So I just think of a question to ask more, because when we were doing our research, we did see that there's an increasing competition between traditional wealth advisor and managers compared to the Wealthtech company. So, and from our paper, we found out that it's best for just women, Gen Z women in specific, to have both the combination of their self-investment and also the help of a wealth advisor. I wonder if there could be a combination of them investing on their own with a wealth advisor assisting them on the side. As what we learned from our research is that this generation, they prefer to have advisor who investing with them instead of for them. Is the question that I have maybe for the team. Have you been able to look into that?
Yeah, I can answer that. So just like Kate mentioned, we haven't done really any specific research on, men versus women and that specific, what these technologies, what demographic they'll be helping in that sense. It's more been about, like, for example, higher net worth versus lower net worth investors. So like a good example that I can give you is Endeavor, which we covered in the portfolio design section. They allow you to create custom portfolios for, you can have $20 million in the bank, or you can have 100,000 and you can still use Endeavor. You can even have 1,000, because they take their fees based on assets under management. And what they have is they could invest alongside you because they have a smaller team of advisors, really for thousands of people. Like I said before, it doesn't really make sense, but you could have that where you're mostly on your own, you're mostly independent. Like, you said in your presentation, a lot of women would like to be, a lot of them would like to invest on their own, but they would want somebody to chime in on the side. So you do get that option depending on the different solutions that you choose. I hope that answers your question.
It does. Thank you.
You're welcome.
Hey, great job, guys. Really terrific. Melissa, you want to go to team 4?
Yes. All right. Great job, team 3. And we're going to switch over to team 4 now.